welcome back. We're here with Hal Ratner from Morningstar, and we're talking about portfolio construction. So Hal, if an advisor were to sit down with a new client, where do they really start when trying to construct a portfolio?
Well, I think you go back to what is the client trying to achieve, and what is their financial profile, and what are their goals. And then I think taking into account, and also what is the risk aversion as well. So I think taking into account things such as, how soon are their goals, how much weight do they put on, again, hitting those goals in terms of how conservative you want to be in the portfolio, or how aggressive. And ultimately that's where it starts. Now, one way to think about doing asset allocation, independent of sort of security selection, and one thing that we do for a majority of our clients is this idea of what's referred to as liability-driven investing. And that's a way to actually explicitly take an estimate of the client's goals and put it into the portfolio. So this has its roots in institutional investing, like defined benefit plans and endowments, and those folks have used this for a long period of time. But the idea is to say, look, if we can define the goals of an individual with respect to an asset class proxy, then we can probably build a portfolio that will get better at actually meeting that liability. So an example would be for a lot of our retirement portfolios, as you get closer to retirement, we begin to model the retirement consumption goal, again, assuming we have no particular information on the individual, as if it's a TIPS bond. So if somebody has a level of real consumption that they want to maintain, we take that idea and we convert it essentially into, the best capital market proxy for real consumption would be a TIPS bond, and you put it into the optimization routine. Essentially, you put it in as an asset that's held short, and then you wind up with a portfolio that to varying degrees is designed to really, defease or satisfy that liability. And the changes of the portfolio with respect to your debt and equity mix, depending on, how long your liability is or how long your consumption is going to be, it's going to make the portfolio look different as well. So I think with respect to portfolio construction, it's always good to go back to what are the goals of the individual investor, what is a capital market proxy that might kind of proxy those goals, and then from a risk perspective, how much risk relative to that capital market proxy might somebody want to take.